Ladies and gentlemen, good day and welcome to the Q4 FY2024 earnings conference call of Moneyboxx Finance Limited, hosted by Arihant Capital. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Jain from Arihant Capital. Thank you, and over to you, Mr. Jain.
Thank you, Michelle. Good afternoon, and a very warm welcome to everyone to the Q4 Financial Year 24 earnings conference call of Moneyboxx Finance Limited. Today, from the management, we have Deepak Agarwal, sir, CFO, Mr. Mayur Modi, sir, COO, and Mr. Viral Seth, sir, the financial controller of the company. So, without any further delay, I'll hand over the call to Deepak, sir, for his opening remarks. Thank you.
Thank you, Harshit. Good afternoon and warm welcome to everyone. We have Mayur Modi, co-CEO, and Viral Seth, finance controller of Moneyboxx Finance Limited here. Before we start the Q4 discussion, we would like to thank our investors who have been of continuous support throughout our journey. This is the first year of our full year profitability, and we are really satisfied of the outcomes despite all the challenges in the last 5 years. Our strong financial performance in FY24 reflects our commitment to growth, efficiency, and value creation for our stakeholders. Getting on to Q4 and FY24 performance, AUM of the company increased 112% year-on-year to 730 crores, including managed book, up from 344 crores in FY23, and it grew 36% sequentially from 536 crores. We are again aiming to double the AUM in current financial year. Number of branches increased 64% year-on-year to 100, up from 61 last year, and 16% sequentially up from 86. In financial year 24, we expanded our presence to 8 states with entry into Bihar in Q2 and Gujarat in Q3. We are only doing secured business in these 2 states, and these states are now coming up very well. This extension is considerably improving geographic diversification of the portfolio. For financial year 25, we aim to expand our presence to 11 states by adding 3 new states from southern India. Further, we plan to add 60 to 75 new branches in existing and new states this year. Disbursements were up 95% year-on-year to 665 crore in FY24 versus 341 crore in FY23. Disbursements were up 87% in Q4 24 to 290 crore versus 155 crores last year. Importantly, we crossed 1,200 crore cumulative disbursement in Q4 24. As of March 31st, we had a cumulative disbursement of 1,200 crores. Interestingly, share of secured business increased very significantly, which grew from 5% of AUM as of March 23 to 24% as of March 24. We will continue to increase the share of secured loans to over 40% by the end of financial year 25. While the total income grew strongly by 154% to 128 crores in FY24 compared to 50 crores, in line with strong growth in business and AUM, operating expenses grew only by 91% to 67.5%. This resulted in company posting profit after tax of 9.1 crores in this financial year compared to net loss of 6.8 crores in FY23. We achieved an ROE of 10.1% in Q4 and 8.1% in the complete financial year. Profitability is expected to further improve, driven by declining cost of borrowing and benefit of operating leverage with growing scale of operations. OPEX has actually declined by almost half in last 3 years, from 24% to then 20, 15, and this year it stood at 12.7%. Excluding ESOP charge, OPEX stood at 12.4%. We still expect this over a medium term to come into single-digit number, despite the expansion in branches. The company has strong unit economics and interest rate improved by 200 basis points to 15.9% this financial year compared to 13.9% in FY23. This is supported by average increase in average loan yield and declining cost of borrowing. FY24 average borrowing cost was still higher at 14.6% because of earlier higher rate borrowing, while in H2 incremental borrowing rates stood at 13%. We expect at least 100 basis point reduction in incremental cost of borrowing this year, driven by rating upgrade and increasing scale. Debt to equity improved to 2.63% from 3.12%, largely because of high equity rates. Liquidity levels remain adequate at 106 crores as on March end, and company has another 35 crores per month of partnership on-time funding available through co-lending partnerships and business correspondent. Asset quality. While asset quality was impacted during the year as agricultural-driven rural economy was affected by high and erratic rains in operating states of Punjab, Haryana, Rajasthan and UP, Moneyboxx has relatively strong asset quality with one of the lowest NPAs in the segment, owing to its focus on essential sectors and robust underwriting practices. Gross NPA stood at 1.4% versus 1.51% as on December, and NPA stood at 1.04% versus 0.94% as on December. Historically, the company credit cost was less than 3% amidst even the extreme situation of COVID. Unlike such conditions in the past, the recent deterioration is expected to normalize, which we are seeing on the ground, and we believe that asset quality will remain strong, especially driven by increasing focus on secured lending, which is, as we said, 24% versus 5% last year. Credit cost stood at 1.34% in FY24 versus 1.48% in FY23. On the debt side, we now have 32 institutional lenders, and we are seeing a lot of new banks and impact funds to come along this year. On equity front, we raised 85 crores, which is the largest equity raise since inception. Out of this, almost 10 crores came up from promoters and 4.92 crores coming in March itself. Now we soon plan to raise another 150 crores in H125 to fund our FY25 extension plan, and process for the same is initiated. We thank you all again for the continued support and trust in our company. We look forward to your questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Pinkesh Takrani from Profit Gate. Please go ahead.
Yes. Hello. Am I audible?
Yes, sir.
Yeah, it's perfect.
Yeah. Basically, I was looking at your presentation where there was a lot of talks about the key ratios in the form of the interest spread, the average lending IRR, and the borrowing IRR. So basically, this is the same thing that we see in banks, like net interest margin. Can you throw more light about it, like how you are planning to sustain this margins over coming time? Because to sustain this kind of margin, you have to lend at a very high rate of interest, and the NPAs would be greater in that case.
Okay. Sorry, can I get the name again?
Pinkesh Takrani. Pinkesh Takrani from Profit.
Thanks. Yeah. Thanks, Pinkesh. So I think one thing we have to see is our lending rates, are in line with the market. So the kind of segment we are in, which is 1 to 10 lakh, and largely where our average ticket size for unsecured loan is 1.6 lakh, and for secure loan is 3.5 lakhs. Our lending rates are very much in line with the market, and this is very much sustainable because that's the trend, for decades now. So we don't see a significant decline on this side. Yes, as secured loans increase, the IRR will come down with few percentage points. But at the same time, you can see that our average borrowing rate is quite high. If you see the larger players, largely people borrow at around 10% or single digit rate. So there is very, very significant scope to reduce the lending rate. And as we said that in H2 only, we have declined it by almost 200 basis points. So we have borrowed in H2 at around 13%, which we continue that, that in first 6 months, our borrowing rate should decline by almost 100 basis points. And overall, we see a good decline in, so definitely the speed at which the borrowing rate will decline, I think it will be lesser than the at which the spread rate declines, the yield rate declines. So we are very, very sure that these are manageable numbers. And even if you see that at peers level, people with even a 10,000 crore book, are able to sustain this kind of interest rates. Because you have to realize that this is a business is relatively higher OpEx. So these margins are very much sustainable, and market is very used to in terms of these kind of rates.
Okay. Just one more question from my side. Since you are portraying or giving a guidance of around 2.7 times and or 3.5 times in AUM and 2.7 times in the profits, right? For such an expansion, you need more of a capital, more of the expenditure on the operating side as well. So in coming time, do you see the industry would be the microfinance and all these things would be in line with your expectations? As we can see, it's a new re-rating may be there in coming time for the microfinance institutions. So what is your expectations on the industry outlook overall, at your level? You would be growing much faster as per your guidance even in the presentation.
So Pinkesh, one thing is that, one is we are not a microfinance institution. We are into individual loan segment. And I think if the reference is towards the ability to raise capital, I think we have over the last 5 years, despite very significant external challenges, we have got very strong support, whether it is in terms of debt or whether it is in terms of equity. Even at a small scale, we have 10, banks, scheduled banks in our portfolio. So one is that all the data points say that the growth in India, especially for the individual loan segment, which is missing middle, is very, very high. The credit gap is very, very high. So one, we don't see any challenges in terms of demand and neither in terms of raising the equity. So that's one part. And as we said that we are not typically a microfinance institution. So the secondly that when you speak about the percentage growth, you also have to see that our base is quite small today. I mean, even at 730 crores, our base is quite low. So doubling up AUM from these levels, or even for next couple of years, is not a Herculean task. Execution is required for, of course, but then it is a doable. And there are players who have these kind of track records. And in the last 5 years, we have really shown that we have been able to grow in a sustainable manner.
Okay, thank you. That's all from my side.
Thank you.
Thank you. Participants who wishes to ask questions may please press star and one on their touchtone phone. The next question is from the line of Mihir Shah from Riddhi Enterprises. Please go ahead.
Hello, sir. Congratulations on a good set of numbers. My first question was
my first question was that we were targeting 15% ROE in the March quarter, and like I understand that
we got 10.1% ROE.
Right, correct. So we were targeting 15%, and I understand that like a few things can be here and there in business projections. That should be fine. But just wanted to understand that like what were the things that didn't work out as per projections, and like what are our to reach to this milestone?
Okay, so I think the cost of borrowing has been a deterrent. Overall, if you see as we explained in the last quarter presentation as well, that the market was challenging this year, especially because of erratic rains. We really felt that credit costs to be increasing, the DPD levels to be increasing a bit. So we had to slow down, and with RBI guidelines and the rate increase has happened. So if you see that the kind of the MCLR rates have gone up for across the board very significantly, so which impacted our borrowing rate and which had a different impact on that. But still, I would say at current level of performance, at current AUM level versus negative ROE last year, we almost have seen about a 20% jump here, close to 18% jump in the profitability. So, given the challenging environment, I believe that that's a good step which we have got.
Got it. And is there any timeline that we are targeting to achieve the 15% mark?
So yes, our target is to achieve in next 2 years. So we have been now a bit conservative on numbers. Depending on how the market is performing, we still want that rates to come down a bit to reach to that number. But yes, by FY2026 we are targeting a 15% kind of ROE.
Got it. And
it could happen earlier. It could be surprise.
Got it. And we have been doing some investors. Hello.
Yeah. Right.
Yeah. Hello. Am I audible?
You are audible.
Yeah. We have been doing some calls lately. So do we have any soft commitments on the fundraise that we are planning, and if there's more clarity on the timeline that we're looking for the fundraise?
We are looking to close, on a very conservative basis. We are looking to close in H1 of this year.
Deepak sir, I'm sorry to interrupt, sir. Your audio is not clear now.
Hello?
Yes, sir.
Is it better now?
This is better, sir. Please continue. Thank you.
Okay. Sorry. So what I was saying is that conservatively we will be able to close the round in first half of this year, maybe by July on an aggressive basis. Yes, for sure, we have received some commitments. And it is of a decent size.
Okay. That's good. And some of the branches now are only doing secured loans. So what is the strategy behind this? Because given that our unsecured business was also profitable, so why are we not continuing that as branches?
I think as this is the pivot which happens with every business as the business grows. Initially, one is that initially we could not have started secured loans because the yield is lower in secured loans, and initially the cost of borrowing is high, and also the tenor of loan. So when we got the funding from SBI, which was at a cheaper rate, plus for 4 years, we started focusing more and more on secured loans. So one is that secure. So both businesses are fine. We don't say anything is wrong. But as we grow, there is an opportunity to grow average ticket size with secured loans. And because it stays over a longer period of time, say 5 to 6 years, the OPEX automatically reduces. So the way it works that, you can, with secured loans, your borrowing rate decreases, your operating cost also decreases because it's a higher tenor loan with similar OPEX. So then, and it is obviously, if you have a 2.5% credit cost in unsecured, with secured you will have almost a 1.5%. So there is a saving in the credit cost as well. So that way it makes sense to have secured business.
Got it, sir. Thank you for your patient answers. I'll get back in the queue for more questions.
Thank you.
Thank you. We'll take the next question from the line of Sahil Sharma from Columbus Finvest. Please go ahead.
Congratulations, sir, for a good performance. Sir, what I was wondering about is, if you look at our operating expenses, like you said, this OpEx is at roughly 12 to 13% right now, and it is coming down over time. Sir, when I look at the ramp up for others, for example, 5-star also gives out their historical numbers. Like basically, if I compare like to like for like when they were of our size, it has always been in single digits, sir. So it's something which is, and like you said, the growth journey is very similar for us also and for others also in the industry. So it is a bit perplexing and like not able to understand why the OpEx is higher for us as a percentage of AUM versus, let's say, how 5-star scaled up.
Okay, so I tell you, if you compare it with, so if you take multiple examples, the biggest difference is one is that 5-star is almost a 40-year-old company. Even when you see the growth, it has been with the secured business. So as I said that when you do, so if you compare 5-star, they are at around 6.7% versus Veritas, they are around 8% plus, and there is I which at around 11-12% because it's an unsecured business. So what we need to understand that trajectory for every company will be different, and also it depends on the product. So if we make it 100% secured product, the OpEx will be relatively lower. But so how we see it that if you are doing 100% secured, maybe you will stay around anywhere between 7 to 8%. If you are doing just unsecured, maybe you are at around 11-12%. And if with a mix, you can be around single digit, which is definitely possible. We feel that 8-9% is achievable. Maybe if we do a mix of it, and if we move fully towards secured, maybe in somewhere around 7 to 8% range. So that is possible. 5-star, yes, it's an exception, but also driven by the very, very high vintage of the company. So I mean, with 40 years of experience, there are some benefits which come into it. But if you compare on a like-to-like basis now in terms of productivity per employee, we are doing a good job.
Got it, sir. So basically, as the mix of secured increases in our AUM, we can expect the OpEx to come down with that.
100% for sure. And that's and I'm not even in the forecast. You see it's continuously with the rising scale because when you're targeting a very high growth company, everything in your operations, whether it is investments on tech, whether it is investment on compliance, or any operations of your business, you have a fixed cost, at a certain level, even at a 300 crore AUM level, but they don't increase, in tandem with AUM increase. So every year, you will have some benefit around it in terms of declining OpEx. Plus, yes, at a branch level, when you have more and more secure loan, your OpEx declines significantly.
Makes sense, sir. So just a comment on the presentation, sir. If possible, it would be very helpful to have some 30-day, 60-day DPD numbers also, sir, because it gives a sort of a pipeline for like how the non-paying or like potentially non-paying assets are sort of evolving over time.
Perfect. We have taken a note of it. So
thank you, sir. That's all, sir. Yeah, thank you.
Yeah.
Thank you. The next question is from the line of Manhar Rao, an individual investor. Please go ahead.
Yeah. Hi, good evening. So
hi,
if I see your FY26 guidance right now of 2,500 crore and number of branches, and if I compare it to the previous one, I think somewhere we have increased the number of branch requirement by, I think, 15 or 20 years. So is it that we need more amount of branches for same amount of AUM because that would lead to, a delay in the ROE which we are expecting because of higher OpEx, something like that? Can you please correct me on my understanding?
Thanks, Manoj.
So, Manoj, it is not about really in terms of ROE, but in terms of, see, what we have realized that, we have built a structure. Last year, we could open 39 branches, with 2 new states. Now, 8 states have come up, and we are entering 3 new states in this year. There are some things which are in control. So, opening a branch, given our experience, is now we feel something is in control. So, we can definitely increase on the AUM front. ROE, yes, it improves, but you cannot control, 100% of it because there are external factors also. So I would not say that it is because of, aspiration to have a higher ROE. In fact, with a larger expansion in terms of percentage, that gives a restriction on ROE. Because you have, just to take an example, last year we opened 39 branches, but out of 730 crore of AUM which we have, less than 15% is contributed by those 39 branches which we opened last year. So what we realize is that this upfronting of expenditure in terms of opening of branches pays you over a period of time. So maybe you can miss the ROE target, by few months or few quarters, but from a longer term perspective, it gives you a significant growth.
Okay. So despite going more towards secured right now, the pace at which we will grow our branches, would that be the same way or will that reduce? Because I think secured and the same amount of customers as we have in unsecured, we can target more amount of AUM per branch. So,
which is possible, but then, at this stage, we feel that, as we are planning about 60 to 70 branches, 75 branches this year, we believe that we can ramp it up, 200 branches per year on a very comfortable basis with more than 10 states this year, 11 in fact. Opening up if you open just 10 branches in each state every year, we are doing 100 branches. So this seems, very much doable and possible. So that will be the agenda. If, more growth comes in because it's secured, it's even better.
Okay, just an accounting question I had is, I think our taxation has been very less this quarter. So is that our losses for previous financial years are still offsetting and, going forward, by when can this tax normalize and by when will we have this deferred? Some clarity there.
So FY2026, the tax will 100% normalize. This will be the last year where we will have tax benefit because of our accumulated losses. So H1 could be the possibly the end, depending on the results. But frankly speaking, FY25 will be the last year of tax benefit which we can accrue.
Okay, thank you. That's it from my side.
Thank you. Before we take the next question, a reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. What is the average tenure of your unsecured loans and of secured loans? Because, given your disbursement, I saw that the AUM increase is not coming to it. So is it a very short-term loan?
Average door-to-door tenure for unsecured loan is 28 months. And for the secured loans, it's about 5 years. So, to answer your question in terms of, even when you do a 28-month door-to-door, you have the average period of just 14 months. And then what will happen to Tushar, in the middle after say 9, 10 months, 12 months, you have a top-up. So the earlier loan closes and you have a top-up. So that is one issue, or that is one part of business when you do unsecured lending. As we increase our AUM towards secured, that earlier previous year will be more and more helpful. So you will see that in all the cases where you have unsecured 2 to 3 year kind of funding, largely the AUM is very, very similar to the last year, and disbursement is similar to your AUM. So which improves as you have higher tenure of 5 to 6 year kind of loan book. So you will see some changes, but it will be a slower ramp up. Last year, we just had 5% from secured. It is this year, especially the H2, where we built our secured loan portfolio.
Okay. And what is the average size of the loan in unsecured?
In unsecured, it's 1.6 lakhs.
1.6 lakhs. So each loan, if you say your expense is around 11-12%, it costs you 18,000 to get the loan. Is that right?
You can say that over a period of time.
Okay. Do you securitize any of your AUM in terms of direct assignment?
We do. Starting this year, we have done it. We have just started a little bit of it. So maybe around 6-7% of our disbursement.
Okay. So if you can include that information in the presentation, it will be helpful.
Although it's there in the results, but
okay, I'll have a look. Yeah. And what would be your 5-year target in terms of AUM or balance sheet size?
5-year target, should I give you? It's about we are targeting about 75 crores. I mean, this is a part of predictions which we make. That's the plan.
Yeah. Okay. Thank you.
Thank you.
Is it better now?
Yes, sir. We'll take the next question from the line of Abhishek Jain from Arihant Capital. Please go ahead. Mr. Jain, I have unmuted your line. Kindly proceed with your question.
Am I audible?
Yes, sir. Please proceed.
Yeah. Thank you for taking my question. So I want to understand what we envisage 3 years down the line, what kind of work, what kind of product will be selling, if you can throw some light on the segment. And also, you can throw some light on how the cattle loan industry is in India at this point of time.
Okay. Fair enough. Thank you, Abhishek. So, Abhishek, in terms of next 3 years, we want the AUM to reach around 4,000 crores. And by that time, definitely majority, that maybe 2/3 of our portfolio will look like secured. In terms of and as every year you will see in last 5 years, initially we were doing only relatively a smaller ticket unsecured loan, about 1 to 1.5 lakh. Then slowly this average loan ticket size increased with repeat customers coming in, and then we introduced secured loan portfolio. Then now we have started. So as I said, that out of the 100 branches, last 28 branches which we started are only doing secured business. So as we grow in the business, some product mix, some these things change over a period of time. So we will have new product introductions. When we are able to reach relatively lower cost of borrowing level. So that's one part. In terms of so the one I would like to mention is that cattle is definitely a very, very significant part of our portfolio, and this will remain a significant part of the portfolio. Having said that, what we say is that for us, the market today is about 1 to 10 lakhs kind of unsecured and secured business loans, wherein you see that overall market size is about 22 trillion, and out of which only 4 trillion is covered. So, after the CRISIL study, so that means we are sitting on a 18 trillion, 18 trillion kind of gap in that, in that segment. Coming back to the dairy segment, I think the market size is very large. It's about 15 lakh crore, 15 trillion, is the market size. And I say that even if 1/3 of it, is just our kind of, dairy farmers which are growing. We are still sitting on 5 trillion kind of market. So per se, in terms of addressable market, we believe that it's too large to be even worried about. It's a very, very large market. Almost 6% of our GDP is a dairy industry. And, in rural segment, this is one of the major contributors to the farmer income, even for a rural population, whether in terms of consumption and production. Milk is something which is very, very important for, rural people and farmers for sure. Otherwise, you have, almost 75 million, milching cattle today. So even, when I did that kind of market, I will reach that segment to be, about $5 trillion, or 5 billion, 5 lakh crore kind of market. We feel there is a lot which can be done, especially with our kind of services, as we have said earlier in the past, that we have this vet thing, which is complementary vet services for our clients. We have agroforestry initiatives. There are new initiatives which are coming up very, very soon. So there's a lot, very, very large market to be served upon.
Okay.
I hope that answers.
Yeah. Thank you, sir. Sir, one more question I would like to ask is what are the risk management practices what we are doing? So how we been maintaining our so much asset quality has been relatively much strong right now. The credit cost is close to 2.5%, right? Now collection efficiency ratio is one of the best in the industry. What we are doing, sir, if you can throw some light.
Yeah. So credit cost today is even higher, even lower. Never actually reached, in these days, so COVID reached, over 2%. So credit cost is even more reasonable. But, having said that, I think it is the overall process really about the credit underwriting. So I think we have done a very, very deep study of all the segments where we operate. So one is that it's a limited menu kind of thing wherein, we largely focus on essentials, maybe kirana and other the contribution.
Hello.
And
sorry, sir, your audio broke. Can you just repeat your last line, please?
Okay, I'm saying that we are largely focused on essentials, so which is dairy and kirana, which is about 75% into food, which is essential segment. And again, the other retailers also are the clothing, chemist. So this is more of a daily routine. So one is that even in the circumstances like COVID, essentials are always required. And, these are not impacted by cyclicality or mostly the seasonality. So seasonality is to some extent is there in terms of, lending, but in terms of usage, these essential segments work really well from a lender perspective. And secondly is that, we have, because of the deep industry knowledge which we have worked out in a way that, we are broadly very conservative when we lend. And then there are processes, which help us, maintain the, whether in terms of incentives for employees which are linked to collection. So there are many small steps, whether in terms of incentive or punitive action if we don't get the collection right. So overall, there are multiple steps. The policies like we lend only when there is a self-occupied residential house. We don't lend to migrants. We lend only when there is a permanent structure for a business, whether it is in cattle or in a shop. So there are multiple such, there are multiple co-borrowers, co-applicants on the loan. So there are multiple things which are attached to overall underwriting, which ensures, whether in terms of visits, seeing the house, to the credit underwriting, which ensures.
I'm sorry, sir.
No problem. Is it better now?
Yes, sir.
So I'm saying that in terms of credit underwriting, there are a lot of steps which we take, which ensures that money comes back.
Thank you very much. Thank you very much for the clarification.
Thank you, Abhishek.
Thank you. Participants, you may please press star and one to ask questions. The next question is from the line of Rohan from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. Sir, carrying forward from the previous discussion, just wanted to understand, sir, what is your collection model?
So largely the collection is only by the employees. We don't generally hire a separate collection team. We don't have the concept of separate collection team. The LRO who has given the loan is responsible for the collection. But obviously, at certain stage, if somehow they are not able to collect, after EMI bounce, there's a calling team for reminders on a continuous basis. And at a certain stage, after 60 days, there is a warning letter. On 90 days, there is a legal notice which is served. So, and then a legal action also. So this is done through multiple initiatives, and collection, especially on the calling side. At least as of now, we have been able to ensure this level of quality with the current steps. That if the need is required, we'll do more. We'll take more efforts in terms of collection as and when needed.
Sure. And this is on a monthly collection model or a weekly, fortnightly? And also, is there a group kind of a structure for collections?
There is no group structure. It's all individual loans, and it's a monthly collection.
So, is it a cash-based collection or it's directly debit from the accounts?
It's a cash-based. So there earlier, like 6 months back, still on bouncing, we were collecting like 40% of the amount in cash. Now it is down to 25%. So now we are taking a lot of payments from BBPS and also through our app. So the cash collection is down to about 25%. Our aim is to reduce, bring it down to 10% over medium term.
Sure. So, sir, if I understand it correctly, when the loan is disbursed, we set up a NASH collection, so which hits the account on a specified date. And if that NASH bounces, then it's a UPI/cash-based collection that happens through the app or otherwise. So just want to understand on the bounce rates on the NASH, what would that be currently for us?
So for every 100 rupees, almost 10 rupees is collecting before the NASH. So, customer will pay up in cash, mostly in cash. So for the balance 90 rupees, which is chargeable, we have about 25% kind of bounce rate.
25%. Okay, sure. And sir, in terms of the customer profile, because the ticket sizes at which we are lending, many MFIs also do this individual loans in the similar ticket sizes. So is there any difference in the customer profile with MFI companies, or how should one look at it?
There's a very significant difference because, MFI, whatever segment you pick up, so if it's a cattle segment, with MFI, you can borrow a loan with, 2 cattle. For us, it is minimum 5 cattle. So the business might be the same, but the profile of customer is very significantly different. So these are, relatively better off borrowers in a rural segment if we do. Similarly, if you do Kirana, in MFI you can have a 30,000 or 25,000 kind of ticket. This is not a permanent structure. It is for us, all the retailers, traders, they have a permanent shop which is reasonably of a large size. So while in MFI you may have people which will largely have less than 3 lakh annual income, for us, every customer has to be more than 3 lakh kind of average annual income. So there is a difference in terms of profile, definitely.
Got it, sir. Got it. And sir, lastly, when in an earlier question you indicated that we have started doing securitization this year, but when I compare the AUM vis-a-vis on the exchange filing, the loan amount which is there, There's almost 100 crores of difference on the book AUM vis-a-vis the loan or the loans which is disclosed in the balance sheet. So just want to understand that difference. And this year also there's a difference of around 200 crores.
No, I think the difference is even more. Difference is about 200 crore plus. So this is
This year 200 crores.
More than 200 crores. So because we have co-lending lines which is from Vivriti. So you have 86 crore from Vivriti co-lending, 36 crore from Mars. So these are our co-lending partners. And we also do BC business, which is a managed book, which is 83 crores as on March. So this makes us about 205 crores and balance is some amount of delay. But as we said that we have about 35 crore per month of co-lending and BC lines from our partners. So that reflects the difference between the book that is shown on the balance sheet versus the AUM which we are talking.
Sure, sir. Thanks.
Thank you.
Thank you.
You may please press star and 1 to ask questions. The next question is from the line of Nikhil Arora, an individual investor. Please go ahead.
Yeah, hello. Thank you for the opportunity and congratulations on the good set of numbers. So I just wanted to know that how many lenders do you have currently and who would be the biggest lender amongst them?
Today we have 32 lenders and per se out of non-banking lenders, Vivriti Capital is the largest lender. So Vivriti Group, I would say Vivriti along with Vivriti Asset Management has on-balance sheet exposure of about 120 crores and plus 86 crore exposure in co-lending. So almost 200 crores within the Vivriti itself. With the Vivriti Capital also having about almost 125 to 130 crore kind of exposure. Within banks, multiple banks are at very similar levels. So whether it is State Bank of India, AU Small Finance Bank, the Manviya, all are at 30 crore line. So there are some sanction letters which we have got. So what we are looking at largely for this year, we see most of our existing bank lenders will be able to disburse anywhere between 30 to 50 crores in money. So by end of March next year, most of the banks should be around 40-50 crores kind of outstanding.
Okay, so that was quite insightful. So also I just want to know if you're having any plans to expand in the southern region and if there are any potential challenges that we might face during the expansion.
So there is definitely a plan. So this year we plan to enter 3 new states, which is Karnataka, Tamil Nadu, and Telangana, and maybe Andhra Pradesh also. But 3 new states of South India we will enter. We have started hiring as well. The challenges are there in every location. So there is competition. There are well-established, large players in the market. But I think the market is large and there is business for everyone.
Okay. And so one last question that what are the company's plan to raise the 150 crore equity in the coming financial year? And if you can throw some light that where does the company plan to utilize this fund? And will this equity fundraise help in how will it help in the company's growth?
So now we are, post the results, I think one of the biggest work we have is to do the equity raise. So we will try to close it as soon as possible. So that's one thing. In terms of equity and debt have to go hand in hand. So if we say we have to reach about say 1,400 crore kind of AUM, we have to double from here. We definitely need equity. So if we want to raise 600 crore of new debt, we would need 150 crore of equity capital there to support that debt. So it's largely AUM expansion, which is the need for funds.
Okay, got it, sir. Thank you so much for the information and all the best of the future.
Thank you.
Thank you. The next question is from the line of Mihir Shah from Riddhi Enterprises. Please go ahead.
So the question was that, our even though we have gone through COVID, our portfolio might slightly be unseasoned. Like even, some erratic rains had some adverse effect on our portfolio. So like even with that, like why are we, eager to expand so quickly at the cost of profitability? Like, is it not a risk if like things go south, maybe say 1% or 2% NPA increases, then it will like be a double or triple of the current NPA that we are having?
No, I think what we have to see is one is that when you say about seasoning of the portfolio, that will never happen. If you are doing unsecured loan, which is where the tenure itself is about 24 to 28 months. So what you have to see is that 5 years in the business, we have customers who are in their fourth cycle in the unsecured loan segment. So you have to see it from that perspective, that seasoning is happening in that way. And second, I think...
So you may go ahead now. There was a follow-up.
Okay. Now the other point you said is, see, what we have to see that we have faced extreme scenario of COVID-1, COVID-2, then skin disease, then we have, rain issue last year. Across all these times that we have seen, even the worst scenario, we have seen 2.7% kind of, credit cost. And that's about it. So now we have, let's assume that 2 to 3% is the credit cost which we will see in unsecured loan and about 1.5% over a longer term. Today, that's not the situation, but I'm saying over a longer term, that's the kind of credit cost, which we foresee. That is well under the, acceptable norms based on the yield which we get. So there is no point that, we need to wait. So when expansion is possible, I think, at this stage we should expand when there's a market. So I mean, updates and profitability is only improving. You see the 5-year trend. The OPEX is continuously declining. That's the only way. Once you have a higher AUM, only then you can, really reduce your fixed cost. I mean, see, staff expenses, the IT expenses, compliance expenses, everything is largely fixed. So the only way to reduce the OPEX is you have a higher base. So I think that's the strategy we are following. Branch anyway, you will realize that, even over a short period of time, it may give some decline in numbers, but then overall, see, because every time it happens in NBFC business, your OPEX is actually a CAPEX. So all cost of generating business are upfront. And, you get the interest income and the PF income over the next 2 years or, through the tenure of the loan, which is there. So I think once you accept that fact, growing, when you have successfully realized that, this model is working, I think there is no harm. I hope this answers your question.
Yes, thank you so much. And before I move on to my last question, I just wanted to, join Sahil's request in asking that if you could please add the T and 60-day, 60-day numbers to the presentation.
Oh, sure, we'll do that.
Yeah, and my last question was that, like, could you once please share the branch level unit economics, please?
Branch level unit economics.
Yeah.
So you have to broadly understand, from the perspective that, branch level unit economics would be very similar to business level unit economics. So, you have a 30% yield to it, and the cost of borrowing, which is there with 16% spread. And generally, the working is that each branch on a monthly basis to start with does an expense of about 2.5 lakhs. So broadly at 2 crore kind of number, because you make about 16% interest spread. and make it 2% of credit cost, so 14%. So for every 1 lakh rupee loan, you will get 14,000 over a period of time. So generally, if you calculate the number on a 2 crore kind of AUM, we are able to break even, to start with. And obviously, then OpEx also increases over a period of time. But if you do the math there, it takes approximately 6 months for a branch to break even. You need to have 2 to 2.5 crore kind of AUM and break even. On a accrual basis, if you realize that each month you are making some profit because the income is all postponed over a 2 to 5 year period. You don't see the money, but overall 6 months you are able to break even. That's what we have seen. I hope that answers. On a call, we can't run the numbers particularly, but you can have a separate discussion there.
Sure, no problem. All right, thank you.
Thank you. Ladies and gentlemen, in the interest of time, may we request all the participants to please restrict your follow-up questions to 1 or 2. Thank you. The next question is from the line of Sahil Sharma from Columbus Finvest. Please go ahead.
Sir, my follow-up question was that if we consider our NPAs, let's say that something has turned into an NPA and we have taken a provision or a write-off against it. In this state, sir, we are pursuing, let's say, legal remedy or we will.
I'm sorry, Mr. Sharma, you are not audible.
And then basically, over time, what percentage of it might come back as a write-back?
Correct.
Hello?
Yeah.
Sir, should I repeat?
Yes, please, sir. Your voice broke, Mr. Sharma.
Yes, sir. Sir, what I was saying is that if we consider the process of, once there is an NPA, there would be at some point a provision and a write-off. And after that, we will pursue legal remedy. And post that, there will be some recovery. And at that point, the recovery, there can be a write-back also. So what I was trying to understand is that roughly what has our experience been like post-NPA? That what percentage of these loans are we able to recover basically?
Post-NPA. So Viral, you might like to contribute here, but generally what we have seen.
Hello?
Typically, what we have seen, am I audible, right?
Yeah.
So what has been our experience is typically once we completely write off the loan, there is roughly around 10% of that write-off is something which is typically recovered and which is written back. So that has been our experience. But I'm just caveating this because of the fact that this is purely unsecured experience as of now. And as you know, there is no collateral in unsecured. Obviously, so the write-back is going to be much lesser. But as we transition to secured, obviously, I think the experience is going to change. Is what is our expectation on this.
And one another point here is that still today we have not filed a single legal litigation against any of our customers, and we have not used even collection agencies. So I think also there will be some improvement in the coming times as we are initiating those processes as well. But as Mayur said, that almost we said in 80 lakhs, so almost 10% is what we have recorded in last 6-7 months.
Thank you, sir. That's all from my side.
Yeah.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the follow-up. I just wanted to understand your expansion strategy because your AUM is small. So, what are your thoughts on expanding within 1 or 2 states with intensive branch network rather than going into multiple states? How do you think about that?
Yeah, Mayur, you want to take up?
Yeah, sure. So Tushar, I think we have been confronted with this question multiple times, and during the course of our journey, from starting first year. See, our theory is very simple. I think the segment that we are into, the real diversification and the risk mitigation comes from the distribution model. The more you are distributed across various geographies, I think both from an expansion and an AUM growth perspective, it helps us because it helps us understand the geography better, the regional dynamics better, the growth prospects better, and also help us manage the risk in a better way. Just to give an example, let's say, last year Punjab and Haryana faced some erratic rains, and due to which, some part of the portfolio was impacted. Imagine having 30-40% of our portfolio in that region, and the whole book would have got impacted. Whilst, because of the fact that we are present in more than 6, 7, 8 states now, it helps us manage the book better. Also, the fact that, we can grow in a reasonable manner in all the states. No state today contributes more than, I think the top state which contributes is Madhya Pradesh, which is roughly 30%. And the next is Rajasthan, which is 24%, and then everybody is roughly around 16%, 12%, that kind of a number. So I think yes, it helps. It obviously adds to the cost of kind of setting up, shop in those states. But what we have tried is it helps us manage the risk better because every area, because of the fact that every area has its own potential, you cannot grow a branch beyond a certain level in each district that we are present. And so it becomes very important to have a very strong distributed model in this space.
And also it's like seeding. I mean, what will start next year will not yield any results in this year. I mean, which will start in this year will not really yield so much return this year. But, it's best for next year.
No, thanks for your answer. But there are many companies, especially in housing finance and all, who have grown by growing in adjacent states. So you could still divide your risk in 4 states rather than being in 1 state. But going to 10, 12 states, such a small size is what I'm wondering.
Also, everyone cannot have a same strategy. I think we are...
No, that I understand. That's why I asked you, what are your thoughts on this? I understand. You're doing business.
That's what we said, that it's better to be more and more geographically diversified. And we have taken, if you see, we have taken that kind of strategy only. So strategy in Haryana, then it's all bordering states. Haryana, Rajasthan, then Punjab, then UP. With Gujarat, we have covered Chhattisgarh. With MP, we have covered Chhattisgarh, then Bihar. So these central and northern states covered. Now we'll move to south. And, it's not very aggressive. It's bit by bit. So it starts, even if you see Gujarat and Bihar, we started with 5-6 branches only last year. Now we'll do, again, maybe 10 branches again. We'll start with 5 branches in each state in south, and then we'll give them 6 months to show the performance, and then we'll move to, but then you have to continuously seed,
Okay.
You have to take a 5-year, 10-year kind of view.
Okay. No, I just wanted your thoughts on this. So because there are obviously different strategies and every company has their plan. So
you can optimize more. Definitely, if you want to improve ROE, it's a good strategy to be relatively, operate in the same location. So that definitely helps. But you can have a different strategy in terms of your longer term perspective.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you.
Thank you, Michelle. So it has been a good journey of last 5 years. We really, thanks everyone of investors who have been with us, especially during the days when we were not really profitable. And we hope that We will continue to do the good work and, create value for our stakeholders. And while also doing, a lot of good in terms of, our beyond lending initiatives, financial inclusion and, on the impact side. So I hope that, we are able to do a good work here. And, thanks for your wishes.
Thank you, members of the management. Ladies and gentlemen, on behalf of Moneyboxx Finance Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you so much, everyone.